Samir, let me begin with you. I mean, we are going to get deeper into conference season, and there has been this lingering thought that that's when the rubber will hit the road and some of these downward forecasts for EPS will eventually come to fruition. Do you see that happening in the next couple of weeks?
We do. I mean, it's just, the longer we go, the more the economic data deteriorates, the more the macro gets to be a little bit more tricky with respect to margins, with respect to interest rates. And so, that cut's going to come. We're not as, I guess, driven by when those happen. I think for us, it's more about risk versus reward. And as Mike mentioned, look, there's a lot of things that, come out as negative right now. And so we'd much rather be kind of a little bit cautious right now with the optionality to get a little bit more aggressive if the market were to fall further.
Interesting. Jimmy, you think the resolute nature of the Fed commentary gets tested here by what some might argue are some stagflationary signals?
Well, when inflation is above 8% and we have a very strong job market, it will be a dereliction of duty for the Fed not to sound very hawkish. So I don't think they're being tested right now. The question is really fast forward a few quarters when unemployment rates start to move higher. You have clear sign of things slowing and perhaps of a recession. That's the time the Fed will have to, be tested and whether they will be fighting inflation or pivot back to help the economy.
Well, a few quarters, you say. I mean, there's a lot can happen in the next, 9 or 12 months or something like that. I wonder, from here on out, does it matter much if the Fed, Jimmy, goes 75 basis points in September or 50 and then says that's probably the last, supersized hike we have to worry about, and then it's a little more data dependent. We see how the economy fares from here.
Yeah, I think whether it's 50 basis points, or 75 depends also on the CPI data that comes out next week. I'm more in the, leaning towards a 50 basis point camp now, given that we're, seeing clear signs of some deceleration in pricing from gasoline to used car prices. But whether it's 75 or 50 doesn't really matter. I think it's really the terminal rate, and I think the expectation is for about 3.75 to 4%, and the Fed is likely to try to stay at that level for a while. But, as I've said, things will change, whether it's in a few quarters or a few months, we'll see. But I do think, given the macro backdrop, when you look at the big picture, a recession appears unavoidable.
Samir, I did kind of list all the challenges that are known and right in front of us in terms of just the trend in the seasonals and what the Fed is doing and all the rest of it. And valuation does not necessarily certainly turn cheap. But I do wonder what you make of either the fact that the market has shown a little bit of an ability to stay above the lows, and then this general sense out there that pretty much everyone thinks they're going to have a chance to buy it lower in the fourth quarter, as far as I can tell.
I think the tricky part is the market's become very short term. So I think people are literally trading day to day, week to week. And I think they're saying, look, until quantitative tightening kicks up in the middle of September, I still have another week where I have to worry, until I have to worry about it. I think, that's probably unfortunate. I think if you look out, to your point, a quarter or two, I mean, that higher rate of, balance sheet attrition is going to hit equities and it's going to hit multiples. And, to your point about valuations, I mean, if we bottom here, if this is a true sustainable bottom, this would be the most expensive bottom we've ever put in on the S&P. Again, I think the question you have to ask yourself is, are you getting paid to take the risk? And I think the answer is pretty clearly no.